Dear viewers, in the last session, we discussed meetings and resolutions. In this session, we are going to discuss audit and accounts. Objective. The objective of this lesson is to explain the audit and accounts of the company and also the borrowing powers and investments of the company. Books of accounts. Section 128 of the Act requires that every company to keep at its registered office proper books of accounts. Such accounts have to be made for the financial year which, in relation to a company or body corporate, means the period ending on March 31st every year. Where a company has been incorporated on or after the first day of January of a year, it means the period ending on 31st day of March of the following year, in respect of which the financial state of the company or body corporate is made up. Financial statement. According to section 129 of the Act, the financial statement has to give true and fair view of the state of affairs of the company, comply with the accounting standards notified under section 133, and has to be in the form or forms provided for different class or classes of company in schedule 3. The terms contained in the financial statements have to be in accordance with the accounting standards. National Financial Reporting Authority. According to section 132 of the Act, the central government has to constitute an authority known as National Financial Reporting Authority to provide for matters relating to accounting and auditing standards under the Act. Appellate Authority. According to section 132, subsection 6 of the Act, the central government has to constitute an appellate authority consisting of a chairperson and not more than 2 members to be appointed by the central government. The appellate authority has to hear appeals arising out of the orders of the National Financial Reporting Authority. Corporate Social Responsibility. According to section 135 of the Act, every company having net worth of rupees 500 crore rupees or more, or turnover of 1000 crore rupees or more, or a net profit of 5 crore rupees or more during any financial year is required to constitute a corporate social responsibility committee of the board consisting of 3 or more directors, of whom at least one should be an independent director. The board of every company has to ensure that the company spends in every financial year at least 2% of the average net profits of the company during the 3 immediately preceding financial years in pursuance of its CSR policy. Internal audit. According to section 138 of the Act, prescribed class or classes of companies may be required to appoint an internal auditor. He has to be either chartered accountant or cost accountant or such other professional as may be decided by the board. He has to conduct internal audit of the functions and activities of the company. Audit. Appointment of auditor. According to section 139 of the Act, every company at its first AGM has to appoint an individual or a firm as an auditor. Such appointee can hold office from the conclusion of the first AGM till the conclusion of its 6th AGM. The manner and procedure of selection of auditors by the members of the company has to be according to what may be prescribed. The company has to place the matter relating to the appointment for ratification by members on every AGM. It is necessary that written consent of the auditor is to be taken before he is appointed as such. According to section 139, subsection 6 of the Act, the first auditors of a company have to be appointed by the board of directors within 30 days of registration of the company. If it fails to do so, it has to inform the members accordingly. The members will then, at an extraordinary general meeting within 90 days, appoint an auditor who has to hold office till the conclusion of the first AGM. Term of appointment. According to section 139, subsection 2 of the Act, a listed company or any other class or classes of companies as may be prescribed is not to appoint or reappoint an individual as an auditor for more than one term of 5 consecutive years and a firm of auditors for more than 2 terms of 5 consecutive years. An individual auditor who has completed his one term of 5 years is not to be eligible for reappointment in the same company for 5 years from the completion of his term. An audit firm which has a common partner or partners to another audit firm whose tenure has expired is also under the same disqualification. Rotation of audit firm. According to section 139, subsection 3 of the Act, the members of a company may resolve to provide that in the audit firm appointed by it, the auditing partner and his team is to be rotated at such intervals as may be resolved by members, or that audit is to be conducted by more than one auditor. Auditor of a government company. According to section 139, subsection 5 of the Act, in case of a government company, the auditor is to be appointed by the Controller and Auditor General of India. Casual vacancy. According to section 139, subsection 8 of the Act, any casual vacancy in the office of an auditor is to be filled by the board of directors within 30 days. Appointment of retiring auditor. According to section 139, subsection 9 of the Act, a retiring auditor may be reappointed at an AGM unless if he has not become disqualified, has not informed the company of his unwillingness, and special resolution has not been passed at the meeting appointing another auditor or providing expressly that he is not to be reappointed. Audit Committee. According to section 139, subsection 11 of the Act, where the company is required to constitute an audit committee under section 177, all appointments, including the filling of casual vacancy, are to be made after taking into account the recommendations of such committee. Removal and resignation of auditor. According to section 140 of the Act, an auditor appointed under section 139 may be removed from his office before the expiry of his term only by a special resolution after obtaining approval of the central government in the prescribed manner. The auditor has to be given a reasonable opportunity of being heard. The auditor who has resigned has to file within 30 days from the date of resignation a statement in the prescribed form with the company and the ROC. In case of a government company, the statement has to be filed with the CAG. Qualification and disqualification of an auditor. According to section 141 of the Act, a person is eligible for appointment as an auditor only if he is a chartered accountant. A firm whose majority of partners practicing in India is qualified for appointment may be appointed by its firm name, where a firm including a limited liability partnership is appointed as an auditor, only the partners who are chartered accountants would be authorized to act and sign on behalf of the firm. The persons who are not eligible for appointment are discussed in section 141, subsection 3. Remuneration of auditor. According to section 142 of the Act, the remuneration of auditors has to be fixed by the company in general meeting or in such manner as the general meeting may determine. The board can fix the remuneration of the first auditor who is appointed by it. Powers and duties of auditor. According to section 143 of the Act, every auditor has a right of access to the books and accounts and vouchers of the company, whether kept at the registered office or any other place. He may require from the officers any information he thinks necessary for the performance of his duties. Auditor to sign audit reports. According to section 145 of the Act, the person appointed as an auditor has to sign his report or sign or certify any other document of the company in accordance with the provisions of section 141, subsection 2 of the Act. Auditor to attend general meetings. According to section 146 of the Act, the auditor has either himself or through authorized representative, who should also be qualified as an auditor, has to attend any general meeting and is to heard at it on any part of the business which concerns him as the auditor. Punishment for contravention. According to section 147 of the Act, contravention of any of the provisions of sections 139 to 146 makes the company punishable with a fine not to be less than 25,000 rupees but may extend to 5 lakh rupees. Borrowings. A company cannot borrow money unless it is so authorized by its memorandum. In the case of trading company, it is not, however, necessary that the object clause of its memorandum should expressly authorize it to borrow. Consequences of unauthorized borrowing. No loan. The creditor cannot sue the company to recover his loan. Injunction. In the case the money advanced to the company has not been spent, the lender may, by means of an injunction, restrain the company from parting with it. Subrogation. In Neath Building Society vs. Lewis, 1889, LR 43, CHD 158, it was held that where the money of an ultra-vires vendor has been used to pay off lawful debts of the company, he would be subrogated to the position of the debtor paid off and to that extent would have the right to recover his loan from the company. Identification and tracing. As long as the money of the lender is in the hands of the company in its original form or its products are still capable of identification, he may claim that money or its products. Mortgages and charges. According to section 77 of the Act, the power to borrow includes the power to mortgage the company's assets or to create a charge upon them. A charge means an interest or lien created on the property or assets of the company or on any of its undertakings or both as security and includes a mortgage. It is the duty of every company creating a charge to register the particulars of the charge with the Registrar of Companies. Intercorporate loans and investments. According to Section 186 of the Act, the Board of Directors of the company can invest or advance up to 60% of their own decision and beyond that with the special resolution of the shareholders. Floating charge. It is usual, though not essential, for debentures to create a charge on the company's assets. The charges which a company may create on its assets are of two kinds, namely A. Fixed charge, B. Floating charge. The normal concept of mortgage is that it is created on some definite or special assets. Such a mortgage is suitable for property which is more or less fixed. The characteristics of a floating charge are as follows. A. It should be a charge upon a class of assets both present and future. B. The class of assets charged must be one which in the ordinary course of business of the company would be changing from time to time. C. It should be contemplated by the charge that until some steps is taken by the mortgagee, the company shall have the right to use the assets comprised in the charge in the ordinary course of its business. Crystallization of floating charge. When the company makes a default or when it comes to be wound up, the debenture holders should take steps to enforce their security by seizing the assets over which the charge was until then floating. When they do this, the charge is set to crystallize. Appointment of debenture trustees and their duties. According to Section 71, subsection 5 of the Act, appointment of debenture trustee has to be made before making a debenture issue, and the fact of the appointment and their consent to act as such has to be mentioned on the face of the prospectus. His duty is to protect the interest of the debenture holders of the company. Dividends. Dividend means the share of profits that falls to the share of each individual member of a company. It is that portion of corporate profits which has been set aside and declared by the company as liable to be distributed among shareholders. According to Section 2, subsection 35 of the Act, dividend includes interim dividend. The Act allows dividends to be paid out of the following three sources. 1. Profits of the company for each year for which dividends are to be paid. 2. Undistributed profits of the previous financial years. 3. Monies provided by the central or state government for the payment of dividend in pursuance of a guarantee by the government concerned. Payment of dividend out of capital is a breach of trust, and the company may require the directors to replace the capital. Reserves. A company may, before the declaration of any dividend in any financial year, transfer such percentage of profits for the year as it may consider appropriate to the reserves of the company. If there is deficiency in profits of a year, the reserve may be used for paying dividend in accordance with the prescribed rules. Only free reserves can be used for this purpose. Unpaid dividend account. According to Section 124 of the Act, where a declared dividend has not been paid or claimed within 30 days from the date of declaration to any shareholder entitled to payment, it has to be transferred to a special account to be opened in any scheduled bank to be called unpaid dividend account. This has to be effected within 7 days from the expiry of the period of 30 days. Transfer of unpaid dividend to Investor Education and Protection Fund. According to Section 124 of the Act, unpaid dividend amount will remain in the company's accounts for 7 years and will then be transferred to the newly conceived fund known as the Investor Education Protection Fund. Once a dividend is declared, it becomes a statutory debt from the company to its shareholders. Dividend to be paid in cash only. Investor Education and Protection Fund. According to Section 125 of the Act, the central government has to establish a fund called the Investor Education and Protection Fund. The fund should be used mainly for promotion of investors' education, awareness and protection. Reserve fund or free reserves. Article 82 of Table F of the Act 2013 and proviso to Section 123 of the Act empowers directors before recommending any dividend to set aside out of the profits any sum as a reserve fund. Such fund is applicable at the discretion of directors for any purposes to which profits may be applied. Bonus shares. According to Section 63 of the Act, if the articles so authorize, a company has the power to convert its accumulated undivided profits into bonus shares. Directors may capitalize any profits and allot to the ordinary shareholders in respect of the net amount capitalized fully paid up shares of the company. Punishment for failure to distribute dividends. According to Section 127 of the Act, where a dividend has been declared by a company but has not been paid, or dividend warrants not posted within 30 days from the date of declaration to any entitled shareholder, every director who is knowingly a party to the default is punishable with imprisonment extending to 2 years and with fine not less than 1,000 rupees for every continuing day of default. The company is liable to pay simple interest at the rate of 18% per annum for the period of default. Prohibition on forward dealings in securities of company by directors or key managerial personnel. According to Section 194 of the Act, director of the company or key managerial personnel of the company is prohibited to deal with forward dealings in securities of company. Defaulting personnel incur the penalty of imprisonment for a term extending up to 2 years or fine of not less than 1 lakh rupees but extending up to 5 lakh rupees or both. Acquisition of any securities in violation of the provisions make the person in question liable to surrender them to the company. Prohibition of insider trading of securities. According to Section 195 of the Act, no person, including any director or key managerial personnel of a company, shall enter into insider trading. Contravention of the provisions by any person makes him liable to be punished with imprisonment for term extending up to 5 years or fine of not less than 5 lakh rupees but extending up to 25 crores or 3 times the amount of profit made out of insider trading, whichever is higher or both. Managing or whole-time director or manager. A managing director, as defined in Section 2 subsection 54, means a director who is entrusted with substantial powers of management which would not otherwise be exercisable by him. The substantial powers of management may be conferred upon him by virtue of an agreement with the company or by a resolution of the company or the board or by virtue of its memorandum and articles. It includes a director occupying the position of managing director by whatever name called. A company cannot appoint or reappoint any person as its managing director, whole-time director or manager for a term exceeding 5 years at a time. No reappointment can be made earlier than 1 year before the expiry of his term. The appointment has to be subject to the provisions of Section 197 and Schedule 5. The terms and conditions of the appointee and remuneration payable have to be approved by the Board of Directors at a meeting and have also to be approved by the company at a general meeting. If the appointment is at variance with the conditions specified in Schedule 5, it would have to be approved by the central government also. The whole-time director is also an employee of the company. By hearing this lesson, the viewer will come to know the various books and accounts that a company should maintain. He will also understand the importance of audit of the company and borrowing powers and investments of the company. I hope you enjoy the lesson and we will meet in the next session. Thank you one and all.